Good evening, ladies and gentlemen. You're watching Startup Central right here on ET Now with me, Sumita Karir. Over the next 30 minutes, we'll be taking a look at the top stories that we're tracking from the world of technology, startups and entrepreneurship. But before we go on and start looking at the first story that we're tracking on the show, let's quickly take a look at the headlines first. बहुत close है. All right, so those were the headlines. And ladies and gentlemen, let's first put the spotlight on Eternal's shares that ended higher in trade today despite a miss on PAT and margins front. Remember, Eternal posted numbers for the quarter gone by. In fact, the Dipinder Goyal-led company, it reported a 90% drop in quarterly earnings to 25 crores as compared to last year, while EBITDA margins of the company also saw a contraction on the back of higher costs. However, strong performance across business verticals that lifted investors' sentiments. In fact, my colleague Snehi is now joining in with more number crunching on what the numbers actually look like. So it seems like a mixed set of numbers that's coming in on Zomato or Eternal's front. Snehi, we've seen the PAT number, the EBITDA number, in fact, the margins number all go down.
Well, yes, all eyes are going to be on Eternal, erstwhile Zomato's Q1 FY26 numbers, which we believe is a strong set of numbers. Now, despite the PAT, EBITDA margin and EBITDA being below our estimates, we still say it's a strong set. Why? Number one, the revenue has come in at 7,167 crores compared to our estimate of 6,624 crores. We were expecting an uptick of 57%. It's been an uptick of 70.5%. Now, despite factors like other costs, other expenses, food delivery charges, as well as ad spends, they have grown robustly over the last year on a year-on-year basis. Despite this, revenue has still been a PAT, which is a beat, which is a big green flag coming in for Zomato. Now, PAT, EBITDA margin and EBITDA have been below our estimates, but these numbers still look good because if you take a look at the segments, overall B2C business NOV, which is the net order value, is up 55% on a year-on-year basis. Healthy growth here. Food delivery average monthly transacting users, the AMTU, has risen to almost 23 million compared to 21 million just on a sequential basis. So big gap up over here as well. The quick commerce revenue has beat our expectations. Quick commerce GMV growth has also done better than estimates. Quick commerce EBITDA loss has reduced and EBITDA margin negativity has reduced, which are two very big green flags coming in for Blinkit. And their average monthly transacting users have also seen a big spike just on a sequential basis. Hyperpure revenue has also beat our estimates, and more importantly, it's the management commentary that looks a beat on the food delivery business, wherein they say that there is some scope of margin expansion and they see this number around 5% of NOV for now. And even better is the commentary on Blinkit in terms of where they say that the margin expansion is right around the corner because the stores 12 months and older are about to mature. They've added about 243 stores this quarter, taking the total store count to 1544 as we speak. However, on the flip side, what we don't like is that they've lowered their food delivery guidance from 20% of NOV to 15% for now, and they believe that 20% can be hit in FY27. Food delivery NOV continues to be subdued, and ad spends, delivery spends, like I mentioned earlier, they're all weighing on the overall bottom line, not the top line. That is a very important metric to watch out for. So, well, yes, all eyes are going to be on Eternal's Q1 numbers. Good set on the back of segmental performance is what we have seen this time.
Absolutely, Snehi. Thank you very much for putting those numbers into perspective, ladies and gentlemen. We'll be joined in shortly with an analyst who will help us decode these numbers further on what these numbers really look like for the country's growth trajectory going forward. But let's first listen in to what the company's management had to say after these numbers came out.
So, yeah, Sachin, I think quick commerce has definitely been a headwind to some extent for the food delivery business because I think some of that consumption has also moved to quick commerce, right? But having said that, I think uh, we still believe from a penetration standpoint and opportunity standpoint, we still do think that long term the business can grow at 20%, although that visibility is not there for the near term at this point. But I think there's enough going for us to be excited about the business. And I think uh, if we do well and we are able to innovate and unlock more use cases for food delivery on the app, then I think we can get back those 20% growth levels again.
All right, ladies and gentlemen, we are now joined by Rahul Jain, the Director of Research at Daulat Capital. Thank you very much, Rahul, for joining us here on ET Now. First things first, how are you looking at these earnings and what really stands out for you with respect to these earnings? And are these numbers along expected lines, particularly, the kind of expansion that Hyperpure has seen and, of course, that profit figure that's gone down considerably?
Yeah, so there is some improvement that has happened in the profitability or the loss of the Blinkit business. And the other businesses have actually seen some kind of a disappointment, be it food business, where we have seen the growth not picking up to the expectation. And in the Hyperpure business and the others business, they have seen the loss increasing. So that has actually resulted into overall loss being higher than our anticipation. That is what I would like to comment.
Right. Rahul, how do you respond to the management commentary that's coming in around the growth rates? In fact, the management says that growth rates will be high at least for the next 2 years and expect margin improvement to continue for Blinkit. And of course, it's been a headwind to the food delivery business. What is your reaction to the commentary coming in? Would you agree with the kind of growth that the company is factoring in?
So while Blinkit business is considered, if you see, they have already identified that they will take it the current store count to 2,000 by the current calendar year, and then they have now also identified in this particular letter that they may take the store count to 2,000 eventually. So we are clearly seeing that the expansion has been quite significant. So revenue growth factor, I think there is no true debate on whether they will be able to maintain a very high growth on the Blinkit business on the revenue side. Of course, what we need to see that with the expansion of this store count, whether the profitability will be optimized, especially going in the smaller cities, that is a different piece altogether to solve. And as far as the food business is concerned, they are hopeful the food business would improve in terms of the growth trajectory. But at this point, it is definitely lower than their anticipated 20% mark, and they don't see that actually shaping up later in this year as well. So to that extent, impact on food business a bit would have come from the quick commerce also, but there is in general also lower demand, I would say, for the food business together.
Right, and of course, we're seeing Rahul competition build up in that sector. But on the side of losses, especially when you talk about store expansion, do you think the company will be able to minimize its losses given the fact that it is looking at expanding and, of course, it is spread across several verticals?
So I think there would be 2 or 3 dynamics that one would have to balance it out in understanding where the profitability will land. One thing is they are moving to the inventory model in the quick commerce business, which will be slightly accretive to margin, although the balance sheet requirement would increase on the working capital side. And secondly, the expansion, which is also coming with lot of competition coming. So their ability to reduce the discount and optimize the business would be function of the competitive intensity. There is a significant operating leverage opportunity out here. but how all three factors would play out would be very difficult to measure, and that is the reason management also have not identified any timeline by which they would optimize the profit, although they are committed to stay on the path in terms of not increasing the losses significantly from the current level, and would see this going down over a period of time.
Right, Rahul. But speaking of, competition that's building up in the quick commerce and food delivery spaces, where does Eternal stand in your opinion? And do you anticipate the market share of a bit of a rejig in the market share with respect to these couple of companies that are currently operating in the quick commerce and food delivery spaces?
So I think competitive intensity is certainly going to increase, and Blinkit being the market leader is the player who might end up losing some market share, and the bigger part of the capacity coming from newer players like Flipkart and all would be more back-ended later in this year. So it would be interesting to watch out that how much of that market share concede would happen. But yes, it is going to be a tough battle going ahead as well.
Right, Rahul. But, speaking about these numbers once again, now that investors have had the time to digest these numbers, how do you think the Eternal stock is going to react tomorrow?
I think there are mixed thought process. Firstly, on the revenue, that is something which people might be excited about. I think there is quite a bit opinion divided in terms of whether the profitability metrics could evolve, how the profitability matrix is going to evolve over the next couple of quarters, which would keep the opinion divided. In our view, it is already not factoring the kind of a risk that the business is expected to face in the next few quarters. But their confidence stance on not increasing the losses in the Blinkit could be something which Street might be excited about.
All right. Thank you very much, Rahul, for joining us and sharing your perspectives on Eternal's numbers that have come out for the quarter gone by. And clearly, Hyperpure, it seems it has registered a significant and substantial growth, but otherwise the PAT figure remains quite lackluster. Meanwhile, in a letter to shareholders, Eternal's management, it has announced the incorporation of Blinkit Foods. It also says that they are maintaining a target of 2,000 stores for a Blinkit by December 2025. And of course, they also say that Blinkit's absolute losses should come down from here on. Well, that remains to be seen whether the company's losses will be curtailed, will come down, but definitely on the back of these numbers, given what investors are banking on or anticipating from the company, the stock went up despite a lackluster set of earnings that Eternal has reported. Meanwhile, ladies and gentlemen, let's shift our focus to the IT sector because it's been a mixed bag of earnings this season for top IT companies. While some players remain optimistic about growth in the second half of the fiscal, others have trimmed their guidance as well. In fact, HCL Tech has lowered its EBIT margin outlook, while Wipro expects a recovery in the second half of this year. My colleague Ashesha is now breaking down the guidance and Q1 commentary from some of these tech majors. Ashesha?
Well, yes, most large cap and several mid cap IT companies have now reported their numbers, and let's take a look at how they've performed versus each other. First up, let's talk about the constant currency revenue growth, where TCS reported a negative CC growth of 3.3%. We had all other companies also several other companies reported negative numbers. Remember, HCL Tech reported a positive CC growth of 0.8%, Tech Mahindra and Wipro at minus 1.4 and minus 2% respectively. Meanwhile, as far as EBIT margins are concerned, for TCS, they declined by about 30 basis points. For HCL Tech, we saw a decline of about 80 basis points. Meanwhile, Tech Mahindra reported a margin uptick of about 60 basis points. So that's the kind of move and constant currency growth and margin profile that we have seen for most of these IT companies. Now, shifting focus to some other parameters then, and deal win, that is also an important metric to watch out for. TCV growth for TCS came in at negative 23%. This was a major negative. HCL Tech reported a 40% drop in its TCV growth. We had Tech Mahindra and Wipro on the other side reporting positive
positive TCV growth of about 1.3% and 26% respectively. As far as employee addition is concerned, HCL Tech and Tech Mahindra didn't report any employee addition. Nearly 5,000 employee addition is what we saw as far as TCS is concerned, although Wipro lost some of their employees in the quarter gone by. But what is crucial is the management commentary and the kind of guidance these managements have given. First up, Tech Mahindra, they said that they will exceed peer average in FY27. Some bit of positive commentary that came in from Tech Mahindra. HCL Tech, meanwhile, went ahead and cut their margin guidance. In fact, EBIT margin guidance has been cut to 17 to 18% for FY26. TCS said that FY26 is largely expected to be a better quarter for international markets. Meanwhile, Wipro, which reported its numbers yesterday, they said that the second half of this financial year is expected to be better than the first half, and they've given a constant currency revenue guidance of -1% to +1% on a sequential basis for the second quarter. So yes, it has largely been a mixed bag across companies in the IT sector, but commentary is something that will be keenly awaited.
Thanks very much, Ashesha, for putting those earnings into perspective. Definitely, the companies are cautious as far as global macro environment is concerned, but definitely there are hopes that Q2, perhaps, I beg your pardon, half two will be better than at least H1 of 2025. Meanwhile, ladies and gentlemen, some news coming in from the Enforcement Directorate, which has intensified its crackdown on illegal online betting networks. The ED has summoned top executives from Google and Meta as part of a money laundering probe linked to online betting platforms. And sources tell us that fresh summons have now been issued for July 28th after both companies skipped today's appearance and they sought new dates. In fact, the agency is investigating whether these digital platforms, they promoted illegal betting apps via surrogate ads. Both firms have been asked to appear with relevant legal documents. In fact, the ED is also examining potential violations that are linked to illegal brand endorsements and the broader role that these platforms may have played in amplifying gambling-related content. So that's some updates that are coming in from ED versus big tech companies. But also, let's take a look at fashion quick commerce related news. Well, Reliance Retail has stepped into the fashion quick commerce segment, and that with the launch of AGO Rush. AGO Rush is a 4-hour delivery service now live in 6 Indian cities. It rolled out in the first quarter of FY26. In fact, AGO Rush offers over 1.3 lakh styles, and according to Reliance, it is already showing promising unit economics. Reliance also says that the move is aimed at capturing the growing Gen Z appetite for fast fashion and instant gratification. Now, AGO now joins a crowded field that now includes Myntra's mNow, Numi, Slick, and a whole lot of other players. However, not all players have cracked the model. Fashion startup Blip shut shop within a year, but definitely one more addition to the quick commerce with respect to the fashion sector is concerned. We'll have to see how that really plays out, but definitely consumers are excited given the shorter delivery timelines. With that, ladies and gentlemen, it's time now for us to wrap this edition of Startup Central. Hope you liked the show as much as we did putting it together for you. From me and the entire team, goodbye and thank you very much for watching.